really want to invest in real estate, but they haven't thought through like the why behind it. I think sometimes social media can feel like everyone's buying real estate. Israel, am I behind if I'm not buying real estate? So, how do you help people figure out if real estate actually makes sense for their goals, if at all?
Certainly, I think social media, which I use now to share and debug a lot of things, it can be overwhelming, right? There's a lot of hacks and tricks, and there's a lot of stories that are missing chapters, right? Ultimately, your why for real estate should be based off of your situation, should be based off of what success looks like for you. The first question that I ask is, what does success look like? Is it doubling your income? Is it retiring early? Is it buying a home that you can live in for free so you can leave to go to B school? I think identifying your why is the first step. I think within that same why is a few other things. What is your risk tolerance, right? I know, Chelsea, these are some of the first questions you ask as well. What is your risk tolerance, and where do you see your risk tolerance going in the next 5 years? Typically we become less risk averse, right? Or more risk averse rather. And so, what does it look like when we are buying a home 10 or 15 years from now versus now, where maybe we have less concerns? And then those two things are very critical, right? Sometimes we may have aging family members, right? And we may want to be able to house them. We may be in a city, a coastal city like New York City, or let's say San Francisco, where it's extremely expensive. And you start doing the calculations and realize that, wait, no matter how much money I'm making, a large chunk of my income is going to someone else. How do I figure out a way to buy, or to buy with friends, right? So I think understanding a timeline for yourself of where you want to be and where you want to go is going to be critical. And then we can always figure out ways to kind of bridge the gap, right? Oftentimes we're thinking about, how do I fund a
Mhm.
a purchase, right? Can I dip into my 401k, or do I sell equity? Versus, hey, I have the time to be able to commit to a property that may need some work, or maybe a little bit further away from where I live.
Yeah, I love that. And honestly, Israel, we think about things in a very similar fashion. So we always like to ask that similar question of what does success look like, or, what do you want your retirement to look like? And maybe that is having a work optional lifestyle, or generating some income from a property or from a business, and understanding how that fits into it. But also acknowledging like how much time it takes, right? As you were talking about with some of these properties, like you are sometimes a landlord if you don't have a property manager. So how are you balancing all of that? And sometimes, the math is not mathing, right? And it doesn't necessarily make sense where you do have an asset, which is amazing, but if that asset isn't performing, like figuring out, does that make sense? Should you hold on to it? Should you leave it? But it sounds like really understanding that why is the most important part and will help you with some of those decisions.
100%, 100%. My why, to give some color here, I love real estate. I love the ability to transform a space, and so I just found love in it, which was, I was very fortunate too. But also, I wanted to replace my W-2. I had, a lot of ambitions. I wanted to travel. I wanted to open up a cafe, which I was able to 3 years ago in Jersey City. Quick plug, if you're ever in Jersey City, pull up to Go Cafe. And I wanted to have time to be able to work on these things. I also wanted to venture into development myself, right? Many of which required more time. And so I started building my portfolio right before I turned 25, knowing that I would have the time and the resource to be able to commit to putting in some sweat equity, right?
Mhm.
Recognizing that as I got older, there's a term, I like to use, the quality of life tax, right? Where certain things just become very expensive, right? We have less time, less free time. We are less willing to probably live in a fixer upper, right? My first spot in the Bronx that I purchased, I lived in it while I renovated it. Wouldn't recommend that, right? But these are some of the decisions that I made earlier on, with the expectation that the income that I would generate would be able to allow me to, leave my W-2 to pursue those other things that I wanted to do.
Yeah, absolutely. In Israel, I have to ask because that's a common question that we'll hear as well is, I'd love for real estate to completely cover my W-2. And then, like, this is what I'm doing for work. I'm passionate. I'm excited about it. But I think it's also important to manage expectations around that as well. So, is there a realistic timeline somebody should consider when thinking about when real estate or potentially how many properties it would even need to cover their W-2? Would love to hear more about that from you.
Yeah, great question. I think when I look at real estate, just in terms of the financials, we have to look at a spreadsheet, right? And depending on what your goals are, the spreadsheet is more complicated, right? There's a few things, we won't go too deep into that, but a few benefits that real estate provides that makes the calculation a little different is you have some tax incentives, right? When you own an asset, you're able to depreciate against it. Long story short, your W-2, you're taxed, depending on your tax bracket. In real estate, you're actually able to generate a greater return net without the tax liability. And so, let's say you were buying an asset and you're seeing a cash flow of $5,000. That cash flow could actually be equivalent to you making significantly more in your W-2. Obviously you'll get a taxed, and that'll be reduced. I think when looking at replacing your job with real estate, you have to think about a couple things, right? One, location. We're in a market now where rates are higher, right? Gone are the days where I know someone who has a 0.75 interest rate, right? They bought down their rate when rates were around like as low as 1.75. Gone are those days, and so our calculations are different, right? Our time horizon is longer, right?
Yeah.
You might buy a property and you might say, okay, you know what, right now this is not really cash flowing, but we could be hopeful with the expectation that maybe in 3 or 4 years we can refinance, right? Reduce our interest, remove our PMI, and then increase our cash flow. So with that question, I would say, we kind of want to plug in a couple of properties, right, into a spreadsheet, figure out, okay, well, how much do I need to cash flow? Consider all the risk, of course.
Mhm.
And even for you, as someone who might be wanting to do this, you have to ask the real questions. Are you willing to put in sweat equity, right? Are you willing to run to a property and fix an issue? We'll talk about this more in a little bit, but when we think about the management and scaling up a portfolio, you might be outsourcing, right? Or maybe you don't have time and you have to outsource from the beginning. That does eat into your cash flow. And so when you start thinking about how real estate can be a part of this, you really have to consider how much time you're willing to put in, and realistically, how much time will it take you to actually get to where you want to be.
Yeah, absolutely. I love that. And I love that we think about things in a similar way of how we want to go through these projections and acknowledging the sweat equity piece. That is not one that we want to forget about. So let's talk about now how you approach evaluating a deal. Let's say a client is coming to you and they say, Israel, I'm looking at purchasing, a multi-unit property. I'd like to have some income. What are some of the green lights that you see where you're like, okay, this is interesting. Yes, this could work for this person. And then are there any sometimes red flags where you'll say, hey, you know what, we should run away from this?
Great question. So I'm assuming here that we figured out our why, we
Yes.
understand our risk aversion and our risk tolerance. Now we're looking at properties and we're kind of building on our strategy. And I call that part the calibration phase, right? Understanding what kind of asset property do you want to buy, and how much work are you willing to put into it. When we're evaluating a property, obviously was looking at the spreadsheets for a property, let's say, of the folks on the call here that may be looking at what is commonly called rather house hacking, right? You're buying a single to a four family unit. You are living in one unit and renting out the other. The analysis will be very different than if we were looking at a commercial 20 unit building in Tennessee. And so the first thing that I want to look at is one, what condition is the property in, right? Um, can the property be rented out right away? Is it turnkey, or does it need to be renovated, right? And ultimately, those costs need to be factored into your actual offer, and then what I like to call the TDC, your total development cost. The next thing is, what are the basic numbers, right? We would take the price of the property, and before this process, in the beginning, we have identified your strategy. We have partnered with a lender, and we've gotten a pre-approval. So the lender has done the reverse math to figure out how much how much property can you afford, and then you've done the legwork of figuring out how much money are you willing to pay towards a mortgage, right?
Hmm.
And so now we're looking at a property. We say it's 3 units. We want to make sure that based off of the average income that I can get, that it's going to cover whatever calculation that I'd made earlier. And that evaluation is extremely important in the beginning. Sometimes you do that before you even see the property, because you want to make sure that you are looking for the right type of property, right? So that when that right property comes in front of you, you're able to jump on it. The next thing you want to consider, obviously, is how much cash do you have on hand, right? There are tons of different programs. I mentioned you can put as low as 0% down to 5 and above. Your down payment is essentially the calculation of 0.05 or 0.035, depending on the type of loan, against the purchase value, right? And so we want to figure out, do you have the down payment amount available? And then two, when you're purchasing a property, you have your down payment and your closing costs. Do you then have the closing costs, which can technically be around 1 to 1.5%, right? So let's say in this case, $12,000. Do I have the 5% I need to purchase it, the 1.2%, the 12,000 I need for closing costs to be able to actually afford that down payment?
Yeah, that makes a lot of sense then. So since interest rates are higher, and I have to assume even whether you're house hacking or whether you're just getting a commercial property and then renting those units out, there is a timeline, right? Like it does still take quite a bit of time, especially if it's not a turnkey property. So I guess how do you help people think about, expectations around how long it takes, from purchasing a property to like actively generating income?
Love that. I think, the thing to remind ourselves is, real estate is real estate, right? It is still an investment, but it is physical, it is real. We can see it. Our investments, sometimes we might buy a stock, but we may not see the growth until months down the line, sometimes years. Real estate is a lot sooner, but we do have to position ourselves for that period of time where we are stabilizing the property. So some considerations to make here. When you buy your property, let's say we closed on our property on Monday, which is the beginning of March, you have about a month and a half before your mortgage is due. And so if we close on a property on Monday, we wouldn't pay our first mortgage payment until that's March, April, until May. And then a cool little hack here is your mortgage payment isn't late until the 16th of the month, right? Depending on the lender. So you have significant amount of time to be able to right size, stabilize your asset from buying to renting it out. Now, depending on the work that needs to be done, going back to our spreadsheet, we need to kind of factor in the time that that'll take, right? Typically, when you are buying a fixer upper, you're getting a good value, right? I like to call that you're in the money, right? Let's say you bought the property, it was after renovated value is 700,000, but you bought it for 600, and then you put in 20,000 for it to be worth 700. That's amazing value. However, what that does mean is you might have to spend a month and a half on a renovation. Knowing, of course, that you are forcing equity, you're forcing appreciation because you're improving the property. But then two, you're also maximizing its value potential. So I would factor that into your calculation. How long will it take you to be able to renovate the property? When is your first mortgage due? And then obviously, doing everything in parts. I think a very strategic first position on a property would be a multifamily, right? That is a property that has, two or more units in it. So if you are looking at a, let's say a three or a fourplex, right, in California, in San Fran, you could essentially, work on each unit one by one, right, and start renting out each unit as you go. In that spreadsheet, you would account for the fact that, hey, I'm going to be receiving income, right, over time. And the cool thing too is, there are some ways to kind of front load some of that early cash flow. Airbnb is a great model when you think about, hey, I have, a higher interest rate. I'm in, a super high cost market. How do I balance my mortgage, or ideally live for free? Short term, even midterm Airbnb, aka renting out units for more than 30 days. That actually allows you to see a much higher rental income, which would account for the month or two where you probably didn't have an income because you were preparing the unit and, of course, renting it out.
Yeah, that makes a lot of sense too. So I want to double click on that Airbnb part because I know we were having a conversation yesterday. And similarly, I think we both ask this when we're working with clients, but it's important to know, what type of investor do they really want to be, right? Do they want to be more hands-on? Like, do they get excited about the idea of the sweat equity and managing the property and really getting in there? Or do they want to have more of a hands-off approach? And I'm curious to hear, like, how do you think about long-term rentals versus Airbnb, and how do you help people decide on which strategy could make sense for them?
Yeah, certainly. It's funny. I have, different types of clients. Some of them are completely hands off. Some of them are less hands on in the construction, but then they'll come in to the designing and setting up of the space, which is fun. I think a number of things to consider when you are investing and thinking about sweat equity. Sometimes it's just not possible because of your work schedule, because of where you live, right? Where your primary residence is, or even skill set, right? There's a lot of things that I learned myself as I went, literally watching contractors do certain things, going on YouTube, but there are some limitations that we might have. I think what we try to do is figure out the actual cost of outsourcing, and figure out if it's worth your time, right? Or if it's worth outsourcing. There's some things that maybe if you are traveling a lot and you need someone to come into your property and take out the garbage, getting an inexpensive service like that, it's not going to break the bank, right? But if you are local and it's a few minutes away from you, and that can save you $300 and add $300 to your cash flow, that's really important. So I think the first thing would be to identify what is the cost of some of these things that you would have to outsource, and then figure out if it's worth it for you to pay that. I think another important thing to consider is sweat equity now versus sweat equity later. I knew personally in my portfolios, because I wanted to retire from W-2, that I would put in a little bit more sweat equity earlier on, so I can maximize my cash flow, build my reserves, etc. But then over time, I would build systems, build a team that would allow for my property to be managed by somebody else, as I went later on in the journey. So going back into the spreadsheet, your cash flow in the beginning, right? It might be lower, right, than what it will be in the future. Not just because you're increasing the rent, but maybe because there are certain expenses that you are paying now that you may not pay later, or vice versa, right? You might want to do some things yourself, but with the expectation that eventually you'll outsource those. But you want to make sure that your cash flow is in a position where you're not losing, and it's that investment still makes sense for you.
Okay. That makes a lot of sense then. Because I know, especially when you're thinking about, getting tenants, there is a little bit of an ease if it's like a longer term tenant, right? But understanding, your goals and what you're planning towards and how hands-on you want to be is also important. On top of that, also considering, some of the tax ramifications of having short-term rentals versus long-term. But I do want to go back and ask you about the loan programs because Israel, I've been seeing on social media, you've been talking about this very specific loan program. So can you share with the community?
100%. Yes. So CRA stands for the Community Reinvestment Act. It is a federal mandate for banks to invest in the communities that they serve, that they occupy, right? So think about it as a anti-redlining law. So if you go to a bank and you say, hey, I want a CRA loans, many of them may not know what that is, but they all have a CRA officer. Essentially, the CRA loan, specifically the mortgage, there are different types, there are different dialects. Every bank has its own interpretation of CRA, and it's designed to encourage increased access to homeownership in specific zip codes. And so this is available everywhere, right? You have CRA in Brooklyn, New York, in Cali, in Atlanta, in Raleigh, North Carolina, and even in New Jersey. And what it allows for is typically down payment assistance, DPA, depending on, you might income out. There are some CRA programs that actually don't have an income cap. There's one currently in Essex County and Union County that you get a $10,000 grant even if you make $1 million a year, which is really cool. And another feature of CRA is typically you are getting a mortgage that is below the going rate. And so currently, I think rates have dropped slightly. We're averaging 5.9. But in Jersey City specifically, and in Brooklyn and Staten Island, one lender offers a 5.125% interest rate, which is amazing. So they're actually paying because they're losing. So they're actually paying for this loan to be issued. On top of that, many CRA loans actually have a waived PMI, private mortgage insurance. So when we think about our mortgage, we have our principal and interest, and then we also have, of course, our insurance. If you heard of the term PITI, then we also have your private mortgage insurance, PMI. And a lot of folks, they tend to not want to buy a property, or they tend to wait to put down 20%. Essentially, PMI is the penalty you pay for putting less than 20% down, right? Essentially, you are paying to insure the loan on behalf of the bank. For CRA loans, you don't have to pay that, right? And so for a home, let's say we're looking at $1 million 3-family in Jersey City, you are actually saving on the PMI, and you are saving on a lower interest rate that can drop your monthly payments by $800 to $1,000.
Wow, that's amazing. So then just to take a step back, so every bank has a CRA officer, even if your direct mortgage person you're talking to just may not know about it. So you may just need to go like a little above them to figure out who this person is. But once you do get access to this, the rate is typically lower. So that can also help with your monthly cash flow. And also, you don't have to worry about private mortgage insurance, which typically comes in if you put less than 20% down, which can also add to your monthly costs because you already have to pay the mortgage, you have to pay taxes, you have to pay insurance, and then private mortgage insurance. So then it's making it more expensive. So then, and every state has this available.
Yes.
Wow. Okay. And is this only for investment properties, or could people even use this for a primary home?
So these are actually specifically for primary homes,
Okay.
right? And so investment properties, they have their own types of loans. You have a DSCR loan, a debt service coverage ratio loan. That's a loan that is given depending on the income, the generated income of the building. For CRA loans, these are primary loans. Essentially, you are essentially buying a property with the intention of living in it. Every program is different, but typically you can go from a single up to a 4 unit, right, and be able to buy it through the CRA program. If you've heard of NACA is a dialect of CRA. Any sort of down payment assistance. Oftentimes, the state has its own lending or grant service or opportunity that the bank might partner with, right? But essentially, yeah, banks are required to issue out loans in certain communities, and so they're going to ensure that they do so by creating these incentives, which are really lucrative, right? And we think about an investment. An investment really is, when you're buying a property and with the goals of it eventually, if you live in it now, eventually it becoming fully rented out property. Your property that you buy now, while it is investment, if you live in it, cool, but that could be a future investment, meaning in 3 or 4 years, I plan on moving out. That becomes a full investment. You are still able to keep that low interest rate, all the CRA benefits, move on to your next property.
Amazing. That makes sense. We have a question that actually just came in the chat. And by all means, if anyone else has any questions, please feel free to reach out. I have a few more questions for Israel and then we'll open the floor. But this one I think does tie into the conversation we're having right now. So, can you combine the CRA loan with NACA or other first-time home buyer or any other credits or programs?
Great question. So essentially, it really depends, right? Typically, you can combine a CRA loan with another grant, but FHA is a separate loan program, right? And so there are CRA FHA programs. FHA standing for Federal Housing Administration. Those are federally subsidized loans. There are loans that exist within that tranche. I strongly recommend conventional CRA, conventional just meaning non-FHA. Why? Because FHA loans tend to come with higher fees. You have a lower interest rate. You have a PMI always with FHA unless you put down 20%. And then also with FHA, you have a mortgage insurance premium. So you're actually paying, a lot of money up front to kind of insure the mortgage on top of that PMI that you pay on a monthly basis. I saw another question about, the requirements around how long you have to live there. So for CRA loans, you are required to live in the property typically for a year. NACA's requirements are longer, I think, depending on where you are, between 3 and 5 years. Some CRA programs could be considered forgivable grants, right? So essentially, NACA is that program I mentioned where you're putting down 0%, but you have to live there for 5 years. And every year you live there, that the capital that they gave you to purchase it essentially goes down by a year, right? So if you don't live there for the 5 years, then you have to repay the down payment assistance that they gave you. Now, this is something important to consider when we started in the beginning, we talked about what does success look like, right? What is your why? What is your goal? If you're looking to build a portfolio, a program like NACA wouldn't work for you, right? But a CRA loan from, let's say, a Kearney Bank in New Jersey, New York, would allow you to buy your property for the first year, and then let's say the next year you can look at getting another conventional mortgage for the next asset that you want to acquire.
Excellent. That makes a lot of sense. So now if we're talking about, the sweat equity piece and doing the research and making sure we have effective investment properties, another question that's come up is how do we think about, if we're thinking about a renovation, a good way to find and evaluate contractors if you decide, the sweat equity piece is not for me?
That's a great question. That's a great question. I think, like, as I continued on in my real estate journey, I recognized that contractors are so important. Whether you're doing development or you are renovating a property or just maintaining it, having relationships are extremely important. So what I've done actually in the Jersey City, New York market is actually just like become vertically integrated. So I actually partner with a contractor who I do work with, and kind of supporting his business to support our clients. As you're looking, in other markets, the first thing you want to do is try to figure out like what good pricing is. It's very relative, right? But you want to understand what good pricing is. And the best way to do that is by having multiple contractors give you quotes. There was a project I was working on where I had about 6 or 7 different contractors come. I took all of their various ideas, which was great because you get to learn. But then 2, I also wanted to understand what the range was. I've worked on some projects where I was priced $1,500 for the same job as someone charged me $25,000 for it.
Wow.
Right. And that was a commercial property.
Yeah.
So, you really want to understand, well, what is a fair price? 2 is trust. This is extremely important. Oftentimes, your best first ask is going to be your agent, and then it's going to be your family members and your friends who own property who've worked with someone. Ideally, you want someone who has worked in the community who has some sort of tie. The next
Mhm.
thing I would check is Nextdoor, right? Hyper social platforms like Nextdoor, Facebook, to find a contractor that is trusted and that is recommended by people in your community. The next thing is payment. Once you figure out, okay, well, this person is trustworthy and this person can get the job done and the price is good. You also want to make sure that you protect yourself, right? You want to pay by milestone and make sure you are communicating that ahead of time. There's a lot of contractors that want like 50% down or 100% down. Very dangerous, right? Very, very dangerous. You want to kind of set your own, understand what needs to be done, set your milestones, and then pay according to the milestone. That helps protect you, and also it also makes sure that the contractor is working fast and is completing the tasks as they said that they would.
Yeah, that was well said, Israel. We have another question that just came in specifically around selling a home. So, if somebody already has a single family rental home, how do they determine if they want to keep it or not? Are there any key metrics that you typically look at? And if they do decide to keep it, how long should they hold the property? Is there any resource for this? Maybe like, should they wait until the mortgage is paid off to sell it or, a certain amount of time? Yeah, any insight would be great.
Great question. I would have a few questions, but these questions are would be helpful for them to kind of figure out their strategy. One, going back to what's your why, right? I'm a big buy and hold guy. Every property that I've bought, I keep. If anything, I'm looking at, and I would probably encourage this too, if I had a single family, I want to see how I can convert it to a two family. Is it
Mm,
zoned? Are we R1, R2? Can we do it as of right conversion to a two family where now I'm getting multiple income? If you're in Jersey City, New York City, Montclair, Cali, can I build an ADU in the back, right? Can I maximize my
yeah.
zoning allowance, right? Because you have acquired that asset. Um, on the other side, is it generating income, right? Let's say it doesn't make sense to do the things I mentioned. Is it generating income? Is the market turning, right? Is that property becoming the an uglier home on the block and it no longer makes sense for you to renovate it and now you're going to sell it? So figure out, okay, well, where's that home in its life cycle? Where's that home in your personal life cycle? Are you willing to invest to make it beautiful? On the flip side of that, let's think about the tax implications, right? Obviously, talking to a CPA and working with your financial advisor is going to be critical here because you want to figure out, okay, well, yeah, I might have a windfall, but what are my tax implications? Have I lived there for the last 2 or 3 years that I can claim, that $250,000 credit where I don't have to pay taxes, or am I going to lose that capital? Or are you going to 1031 it? Are you going to take the money amount of money that you made, the net income, and then transfer that to another asset? So these are some questions that I would ask. It all really is based off of your initial strategy to make sure that it makes sense. But single families, I think they're beautiful things, but now, especially in the community that you live in, we need more units. We need more housing, right? And cities are getting very strategic on how they support homeowners in converting a single family into an opportunity for multiple families to live in it.
Yeah, I love that. I love that. And I think you brought up a really important part, which was understanding your strategy. Like, what was the why behind purchasing this property? And then making sure that it's still effectively helping you, whether it's the income that it's able to generate. I know you mentioned that the mortgage is already paid off. And then figuring out what the financial ramifications of that sale are, like you were mentioning with taxes, or is there an opportunity to do that exchange and then get another like kind property to defer the taxes? So I think all of those different pieces are really why you want to have that accountant and financial advisor in your corner to make sure that you're making the best decision for your financial plan. Um,
100%, 100%. And I think the cool thing too is having an asset that's paid off, that's still leverageable is huge, right?
exactly.
Because that becomes a bank that you can borrow from to be able to, go back to what's your goal. If it's another asset, take from there, be able to buy the next one.
Absolutely. We always say assets can always create more assets, right? So once you have more than 20% equity in that home, you can take a loan against it, whether it's through a home equity loan or a home equity line of credit. And then you can purchase additional properties and then use the income from that property. But I know another one that we often talk about is asset-based lending too. So if you do have a brokerage account that has grown significantly, maybe over $250,000, depending on where that account is held, you could potentially take a loan against that too. And then use that as a vehicle to potentially purchase investment properties if that makes sense for your financial plan. I always say personal finance is personal, and you should make sure that you're getting direct insight. But I think these are some really cool levers that you and I have both seen individuals use. Um, I do want to ask one more question before we open it up to everyone else. So how do people even start with research for some of these opportunities? Are there any tools or insights you can provide there?
Yeah. So in opportunities in terms of just properties and
Yes.
starting the journey.
Yeah, whether it's ideally a multi-unit investment property.
Yeah, certainly. I think, starting off, I think speaking with your financial advisor is critical, right? Let's figure out, what a good number is, what a good starting mortgage is, best case, worst case scenario. Then partnering with a real estate advisor, right? Not just an agent, but someone who understands the market. I think that can kind of help you figure out your strategy for your research. When it comes to that phase that I call the calibration, platforms like Zillow, Trulia, I always make this joke, let's take half our time off of Instagram and start scrolling on Trulia and Zillow, right? Let's
I like
start
that.
figuring out what we don't know, right? Let's know what we don't know. There's some properties we'll wonder, why is it $5 million? Well, it's because it's next to this building, right? Let's
Hmm.
understand, okay, cool. That doesn't make any sense. It's $5 million, but I can only make $6,000 in rent, right?
Yeah.
Let's try to start understanding our markets, and start to kind of filter things down. Oftentimes, I have conversations with folks in, expensive cities like New York and Jersey City, and we're looking at Philly, we're looking at Detroit. I've traveled to Detroit to try to figure out, like, how is it possible that a 40-unit building is under $100,000, and we know why, right? Oftentimes, just going to an area isn't enough. We really have to make sure that we understand the microeconomics of that area, right? And so I always say start with the research locally, like figure out the pricing of properties and in your local community. The next thing is there's tons of events. There's tons of real estate events. Again, take things with a grain of salt, right? You'll meet folks that are really engaged in real estate, and some folks that are kind of in and out. You want to make sure that you are getting as much information as you can, learning. Maybe you'll find some cool deals that are attractive, and you'll want to pursue. And then you definitely want to get pre-approved, right? Speak to a lender, understand your buying power. Many lenders can actually give you a pre-approval without pulling your credit, and so you can ask your lender, "Hey, can you do a soft pull?" Right. One of the conversations I often have, and I used to be this way, where I was like, "Hey, I want to buy a property, but I'm not sure if I'm going to buy it next month or 3 months from now." Right. So you don't want that credit pull to be on your record. Most lenders can do a soft pull, and that allows them to be able to identify and say, hey, you can qualify for this, or you'll need to improve your credit, or work on this to be able to get to a higher amount. On the other side too, generally speaking, with a lender, they can help you solve any issues that you have. And so if you have any financial delinquencies, or you're working through something, they'll actually be able to advise you on that. And then the last thing, there's tons of podcasts. We spoke about Instagram as a resource. Bigger Pockets is an amazing podcast that put me on to just a lot of really cool strategies. Again, I love what Chelsea said. Your financials are personal, like they're yours. And I think your approach has to be individualistic. I've seen some folks that only invest in trailer homes, right? And they've made a ton of money on that. There's some folks that only invest in condos, right? You might read an article and say condos are terrible. I own 2 condos and I love them, because if I never have issues, and if I do, the super is going to come and fix it, right? So
Yeah.
understand all of the various strategies within real estate, and then once you've kind of figured out what you like, partner with the folks that really understand it that can help you kind of filter through the noise.
Yeah, that makes a lot of sense. So I think the biggest takeaway I receive from all of that is, cut that doom scrolling time in half. Maybe spend a little bit of time on Zillow. If you know on your vision board for this year or the next few years, you want to purchase a property and it's really important to you in your financial plan, give it really the time it deserves to make sure that you're planning effectively there. One that I also like is Air DNA. I feel like I spend a little too much time on it, if I'm gonna be honest, but I like it a lot because it shows you the different income potentials in different cities, in different locations. So I think that's also really exciting to see, like, what is the untapped potential in certain areas, and especially if they're in your backyard, it may be something that you want to consider.
100%. Yeah, I love AirDNA. Also great for short-term rentals as well. If you're looking to understand, okay, well, is it true that I can like get 2.5x my long-term income?
Right, and making sure your assumptions are accurate. I love it. Well, we'll open it up for any questions. I know I actually have one right now that I want to make sure that we're able to address. And it is actually back to our CRA loan. So can you do the CRA if you already own a property? I know NACA is only for first-time home buyers.
Great question. Unfortunately, CRA is for first-time home buyers, right? So
Okay.
if you own a property or your name is on a deed, you cannot take part. But if you have like, but your friend, your partner who may not be on the deed, they would actually be able to purchase it
Okay.
through that program. Another thing too is, after you've obviously taken advantage of your first time home buyer opportunities, if you sell, you qualify again for CRA in most first time home buyer programs after 3 years.
Okay.
After selling and your name is off a deed for 3 years. And then of course, after you've bought your first crib, you can essentially buy, every year, every so often, depending on your strategy, right? If you're moving to, cities for work or for school, right? Or you just decide to kind of hop around, you can actually leverage conventional mortgage to be able to buy products in different places.
Amazing. I love that. So, how do people decide? And honestly, I am the daughter of somebody. Well, first, I'm the daughter of a mortgage banker, first and foremost. My dad is. But then I grew up in a condo slash co-op, I guess more of a co-op situation. And I think I've seen the frustrations around that HOA fee. So, how do you decide if you're looking at, I guess, a co-op? What is a reasonable HOA fee, and how does that fit into, some of your cash flow plans if this is an investment property? This question came from someone where they said it has really hindered them from looking at these types of units as an investment property.
Yeah. So a few things that I typically look at, going back to this, what does success look like? You want to make sure that whatever asset you're buying allows you to buy more assets, right? And so you don't want to buy a unit that, once you leave, you're not going to get the rent to cover the mortgage, right?
Right.
And when the mortgage banker is doing the calculations, they'll say, okay, well, hey, you can't afford this new house because you got to sell this property. Condo versus co-op. Condos, you own the unit. Co-op, you own shares in the building. Co-ops are unique because you're essentially taking the cost of management and you're like leveraging it. I like to say through posterity. So a co-op can take on a mortgage, and you'll have a higher HOA because it's probably including taxes in some buildings. It's including all utilities, water, heat, electricity, right? So make sure those numbers make sense. You still have to go back to the spreadsheet and make sure, okay, well, if I was to leave this property, how much can I get on the rent, right?
Mm.
If my total expenses are 3,500, but I can only get $3,000 in rent, then I'm paying $500 for this property. Is it worth it? Co-ops and condos don't appreciate as fast
Right.
as homes do, right? So what will this asset look like in 10 years? I would look at the historicals, look at the building, how long, what has depreciation been in this building specifically, right? The next thing you spoke about the HOA. I want to physically go to the building and even ask the management company and see, hey, what capital improvements have been made, right? Oftentimes HOA fees go up because there are significant capital improvements that need to be made on a building. Sometimes you may not find this out until you close, which is why you would call the management company and say, hey, is the roof good? Right? Is the foundation good? Is the elevator good? Are there any exorbitant expenses? I think condos are a great way to start. Um, they I think shift our mindset and they allow us to own. I think they're really good, especially if you travel a lot and you need someone on site to be able to support you. But definitely be wary of fees that make renting actually better in this scenario. I think there's very few cases, but there's some cases where renting might be better than acquiring, let's say, a co-op, where in New York City is notorious for this. You can get a co-op midtown probably for 150,000, but then your HOA is $2,500 a month, right?
Yeah.
Very, very cost prohibitive. Obviously, that specific property I'm referring to has a land lease, right? So also understand, like, what is the ownership structure looking like, and how does that impact my equity and the growth of my investment.
Absolutely. And I think New York and New Jersey, dealing with the HOA and planning around that is just incredibly difficult. New York, I always say, is one of the few cities where, it is actually more advantageous to rent. Like the quality of home that you can even have in New York, is better because of the lifestyle you may want to have with the amenities and the location and all the things. Where if you are purchasing and you have that HOA that can increase pretty significantly each year. Israel, I'll tell you on the side how our HOA has increased over the past 20 years. It's been insane, but I do think it makes it harder to plan. But looking at the numbers is really like the first step that you need to do. So we have our last question here, which is from somebody where they said they have, if you have any experience purchasing real estate with family members or friends or thinking about this as like a syndicate, and do you have any advice or best practices if somebody wants to do this as a group instead?
Love it, love it. I wish you had more time. We can have a whole nother webinar just on buying with friends and family.
Yeah.
Um, I think it's one of the strongest strategies that we can deploy. It allows us to buy sooner. It leverages risk. Um, when we opened up the cafe, myself and some of my co-founders actually bought the building together. And that allowed us to do it sooner. When we had the opportunity to buy, it was, super last minute. We had spent all our money on building the cafe, but pulling together capital, pulling together credit scores, pulling together income allowed us for that to happen. So happy to connect offline on this, but some of the things that you want to consider is everyone has to align on their time horizon. Everyone's why has to be identified and somewhat equal, right? You want to protect yourself against a last minute, hey, I don't want to live here anymore, or hey, I want to take my equity out, right? Two, the numbers have to make sense, right? When you have multiple different parties, you probably want an asset that is going to deliver a really good return because you're splitting it amongst different people. Three, you want to be able to build out an operating agreement, right? Who does what when, right? Who's in for sweat equity? Who is going to put in the capital? Who is responsible for an emergency, right? Identify all of the unknowns, figure out the things that you don't know. I actually partnered and work with a startup called Nestment that focuses on actually helping friends and family co-buy, and right. And so we kind of take you through this journey of thinking about, hey, what are you looking to do? And then two, how do we get you there? So Nestman.com is a dope platform. It actually allows you to kind of, throw in some properties, do some quick analyses and figure out what makes sense for you. But I think it's an important strategy, especially in the New York, New Jersey, Cali area. More and more people do it. Believe it or not, we've seen a lot of cases where, aging parents are buying with their children, right? And so, they're living in one unit or the other, they're buying a property and then they're building an ADU, an accessory dwelling unit in the back of the home that the family is living in. So I think it's a great way of scaling your portfolio. And then if you're a busy person or you don't have the time to commit, but someone on your team does, that just allows you to be able to get into real estate sooner.
Amazing. So what I'm hearing is part two is we can really go deeper. We appreciate that question. Before we close, if this conversation got your wheels turning about how you want to invest in real estate, it's important to know that real estate is just one piece of your overall financial plan, right? And this can be a great tool to build wealth, to generate income, but also to plan for tax efficiency. But you need to make sure that you have a clear long-term time horizon, or at least you're on the same time horizon if you're going in with other people, and you understand the why for this investment. So please stay tuned. We'll actually be doing another webinar talking more specifically on entrepreneurship through acquisition next. So please like our Zenith Wealth Partners page, and make sure that you follow us as well. And then Israel, thank you so much for your time, for your knowledge, for your expertise. Where can people connect with you?
Yes. So I'm on Instagram, Israel Estate JC, Israel Estate JC, and then email. It's my last name, Adeyanju, Adeyanju at newandmodern.com. I'm often also at the cafe, Co-Cafe at 722 Grand Street in Jersey City. So if you ever buy, feel free to hit me up there.
Amazing. Well, thank you all again for the time, and tune in for the next one.